Good morning, dear students.
Very good morning, sir.
Very good morning, guys. Happy Ganesh Chaturthi to all.
Thank you,
So,
sir.
today is a very auspicious day, and what could be better than we're continuing our learning journey on this auspicious day also as a compliment or as a as our devotion towards Lord Ganesha. So, we have been through this journey into the topic of security valuation, and in that we have covered quite a few number of concepts, and I think the last session was really impactful. That is what I can understand, because we have covered the security valuation in the part of equity as well as with regards to the bond, right? So in the bond also we have seen the modified duration, the Macaulay duration, the limitations of these concepts, and of course we have learned something called as convexity. Right, so we have learned something also called as the convexity, which was covering the curvature of the bond. And after that, we had also visited a very wonderful concept called as bond immunization, which ensured that we are getting the amount of capital, we are getting the amount of money which we want as a fixed amount, right? So without any compromise with regards to the maturity value, we were able to achieve our targeted amount, right? So that was what we have done till now with regards to bond immunization. Now we have to cover the remaining concepts that are left out in this chapter, right? So before we go on a break, we will be completing this topic of security valuation. And then later on, post-break, we will be starting with a new topic called as the portfolio management. Okay, so we'll be getting introduced to the topic portfolio management. Today we will be, doing some part as security valuation, and the remaining part is going to be dedicated towards portfolio management. Okay, so let's try to cover or complete the remaining questions that we have, right? And then later on, we will go for the next concept, the next topic. Okay, so now one concept that we have to cover over here is with regards to the decision of bond refunding. Okay, so bond refunding decision is what we are going to look at. What do you understand by bond refunding decision, guys? Any idea what are we really understanding by this concept of bond refunding? What do you understand by bond refunding decision?
No idea from my side, sir.
No idea. More essence, we can say it is bond refinancing. Okay, bond refinancing decision. Now, bond refinancing decision is what we are going to cover up over here. So, bond refinancing decision is, replacing the old bonds with the new bonds. So, bond refinancing decision is basically replacing old bonds with a new bond. So, old bonds will be retired because possibly the coupon on those bonds is, higher, and new bonds will be coming in. But that is possible only if those bonds are callable bonds. Only if those bonds are what? Callable bonds. So, do we know what are callable bonds? What are callable bonds, guys? Any idea what are callable bonds? No? Well, callable bonds are the bonds in which, these are the bonds in which issuer, basically the company which has issued the bond, callable bonds are the bonds in which issuer has a right, the callable bonds are the bonds in which issuer has a right to call back or basically redeem the bonds. Issuer has a right to call back or redeem the bonds before due date. So issuer is having that right that it can call back the bond, or basically it can redeem the bonds before the due date. So it can redeem the bonds before due date. So before the due date of expiry, it can be redeemed. So let's say if the original tenure of the bond is 5 years, and if the bond is a callable bond, then the feature will be there that the company may redeem this bond after 3 years. Right? So after 3 years, the company can redeem the bond. That's the power which the company is having. Right? That's a callable bond. Now, why do you think that a company would be interested in, redeeming the bonds before due date?
Sir, I guess if the bond is coupon rate is high, or based on that particular year, the market situation, the other bond is trading the coupon rate very less, which means this bond is issued with a higher rate.
So maybe
So that based on the
maybe this bond was issued at a point of time when the rate of interest was high, and therefore you
high,
have offered a higher coupon rate.
higher coupon.
Now you are looking at an advantage that since the market rates have reduced now, since the interest rates have reduced now, right? Since the interest rates have reduced, what is going to happen? Since the interest rates have reduced,
then they will recall that bond, then issue the fresh bond.
and we will say, let us issue
prices will increase.
Let us issue fresh set of bonds and then recall the previous
old bond.
Right? But obviously, the decision is not so easy that you just look at the rate of interest and then take a call. Right? I need to factor in a lot of things before I, take a call whether the bond should be refinanced or not. I need to factor in, other aspects also before I go for deciding whether the refinance should be done. So it is typically going to be like a NPV problem, like a capital budgeting problem, wherein we take into account everything, the present value of cash inflows, present value of cash outflows, everything will be taken into consideration. Right? So everything is going to be taken into consideration, and that's what is ultimately going to decide whether a particular bond should be refinanced or not. Right now, so sir, what are we really talking of when we say bond is going to be refinanced? So what factors are we really going to count? Right? What factors are we really going to count before we take a decision? So it's like, obviously, what is the amount that I need to pay? Because if I'm going to redeem the bond before due date, I need to pay some premium to the investor, right? Because unless I pay premium, why will the investor return back the bond to me? Correct, guys?
Sir, is that based on the agreement that the callable bond any time can be called upon?
No, it's not going to be any time called upon. It can be called only after expiry of certain number of years or on a particular date only.
Okay, there should be a minimum login period should be there, sir.
Yeah,
minimum period.
Can't be the case. I issue the bond today and then call it back tomorrow. So we don't want that sort of volatility. So we may put that will be like put up in the conditions of the debenture that the bond is callable maybe after 3 years, or it's callable in third year or in the 5th year or in the 6th year. So these sort of conditions can be there. So every time the calculation, every time the company is going to take a call whether the bond should be refunded or not. Okay.
Right, sir. Then sir, that is situation that the investor has obliged to return the bond, right?
Yes. Then the
Obviously, when
investor
there
is
is a
obliged.
agreement.
Yes. Because investor has accepted the bond contract. So
Yeah.
if the company calls it, then the investor is definitely obliged to, call the bond. And I mean, the investor is definitely obliged to fulfill that obligation, and he'll have to return the bond. He can't deny on that. Okay. Now, so how do we decide whether a bond should be refunded or not? You have to do it like a typical capital budgeting problem because it's a capital budgeting decision that we are taking. So I need to look at what is the coupon that I will pay on the new bonds. What was the coupon I was paying on the old bonds? Then what will be the cash inflow? What will be the cash outflow? Like what will be the money that I receive? What's the money that I'm going to receive when the new bonds are issued? And what will be the outflow? And it also take into account the tax effect also. Okay. So let's understand this bond refunding process with the help of an example. So let's look at this question number 24, guys. Now. Let's have a look at this question 24. ABC Limited is having 300 million 12% bond outstanding with 6 years remaining to maturity. So as of now, the principal outstanding is 300 million, the face value, on which we are paying 12% interest. And this is outstanding for 6 years, which is, 6 years are still to maturity. Since interest rates are falling, ABC Limited is contemplating of refunding these bonds with a 300 million issue of 6-year bond carrying coupon rate of 10%. Okay. So ABC Limited is contemplating of refunding these bonds with a 300 million issue of 6-year bond. So we are going to have an issue of another 300 million of 6 years bond. So we're going to replace this existing bond with a new bond. But the feature of this new bond is that it is going to have a coupon rate of 10%. So 12% bonds are going to be replaced by this 10% bond. Issue cost of new bond is 6 million and the call premium is 4%. So when we are issuing this new bond, we need to also incur this expenditure of 6 million. And we will also have to pay a premium of 4%. Right? Because unless and until they give this premium, the investors won't be obviously ready to offer their bonds to us. 9 million being the unamortized portion of issue cost of old bonds. We have 9 million in our books, which is not yet amortized. And of course, this amortized portion of the issue cost is not yet written off in our books and can be written off no sooner the old bonds are called off. Obviously, as the old bonds are called off, this 9 million is going to be written off. This is not a cash flow, but when you write it off, you will need to obviously take into account the tax advantage of that. Marginal tax rate of ABC Limited is 30%. You are required to analyze the bond refunding decision. Okay, so we have to decide whether the bond should be refunded or not. Right, so let me just take the question over here.
Sir, I need one clarity. So generally, when the bond is replacing, whether the existing bondholder will surrender their bond and get that new bond, or
No. It is a different issue altogether.
Okay, which means that the existing investor may not be the investor, but the new bond.
They can subscribe to the new bonds of the company from the market separately.
Okay,
But there is
either
no
altogether
compulsion
separate.
Yeah, but that will not be a compulsion on the investor to replace the old bond with a new one.
Oh, okay, sir.
Okay. So we are going to decide whether the refunding decision should be undertaken or not, simply based on the NPV calculation. Now, just in case, what all things are going to be there in the NPV, and then we'll calculate the other aspects. One second, let me take it to the other side. So, if you look at over here, what all things are we going to have in our NPV calculation? So, calculation of NPV of bond refinancing. Now, what cash flows is the company going to have when it is thinking of refinancing the bond? Year, particulars, cash flow, present value factor at now what will be the rate of discounting? What will be the rate of this discounting? So you can definitely say the current cost of discounting, refunding these bonds with a new bond carrying a coupon rate of 10%. So it means as of now, the rate of cost of debt is, 10%. But right now, let me just keep it as it is. And then we take the PV. First, we will write down all the particulars, and then we'll go about, calculating the cash flows for each of them. Now, first of all, when you're taking a decision of, bond refunding, what is going to happen is you need to pay money to the old bondholders, and you are also going to get money from the new bondholders. Am I right, guys?
Yes, sir.
Right. So, in year 0, we will have something as a initial outlay. Initial outlay. This is going to be the net effect. Initial outlay is going to be the net effect of both the things. Which are the things? Is going to be the net effect of both the things. Which are the things? One
Sorry,
is
Issue price of the
cash
new
flow
bonds,
from issue of new
call
bonds,
premium,
and the cash flow from the
call premium.
retirement of the old bonds, because you're not just going to pay the call premium, rather you're going to pay a full amount to the old bondholders. Okay, so initial outlay, let us call it as a working note number 1. Working note number 1, which is calculation of initial outlay. Okay, so working note 1 is calculation of the initial outlay. Now, what sort of cash flows are we going to have when we look at the initial outlay? First up, face value. What will be the face value of the bond to be redeemed? Face value of bond
300 million.
to be redeemed. That will be 300 million. Add call premium at the rate of 4%. What will be the call premium on 300 at the rate of 4%? What will be the amount of call premium?
12 million.
4%. So I need to pay 12 million, right? So what will be the total cash outflow for bond redemption Can I say 312? But I am also going to get, the proceeds from the new bond, right? So let me make it as this is first. I need to also look at the second set of transaction wherein I'm going to get proceeds of the new bond issue. So we will say gross.
Sir, what about the interest, sir? The coupon interest, whether we will pay?
Coupon interest is going to happen in future. I'm just saying right now, what is the cash outflow or inflow? Whatever is the changes in the interest, that also we will consider. But that is for year 1, 2, 3, 4, right? Not in year 0.
Okay.
Right? So gross proceeds of new issues. What is the gross proceed that you have from the new issue? Can I say 300?
300.
Gross proceeds of new issue is going to be 300 because 300 is what you're going to get. But wait, out of this, you know, you are going to definitely have an expenditure of issue expense, right? How much is the issue expense? How much is the issue expenses? Issue cost on the new bond will be 6 million. So issue expense is going to be 6 million. So net proceeds that we get from new issue, net proceeds from new issue is 294, right? Now, as of today, the call premium which you are paying is 12. Are we going to claim this for tax purpose? Yes. So are we going to save any tax on that? Yes. So what will be the tax savings on call premium? Tax savings on call premium. This is going to be 12 into 30%, which is 3.6. Tax savings on call premium is 3.6 because the call premium that we are paying 12, on that we will be saving 30% of the tax. Right? So this is my cash flow number 3. And also there is an unamortized issue expense of 9 million, right? And which will be written off as the old bonds are called off. So as we are going to call the bonds, we are also going to write off those unamortized portion of the issue expense. Are we going to save tax on that? Yes. So we also need to account for that, wherein we are going to say what is the amount of tax savings on writing off of unamortized portion. Unamortized portion of issue expense. Tax savings on writing off of unamortized portion of the issue expense. Unamortized portion of issue expense will be written off as 9. Right? So on that 9, you have 30%, which is 2.7. This is our point number 4. So now if I say what is the net cash outlay, net initial outlay that we have today, net initial outlay will be like the cash outflow that we have minus the net proceeds that we have minus tax savings on the call premium minus tax saving on the writing off of unamortized portion. So this is 312 minus 294 minus 3.6 minus 2.7, which is 11.7 million. So net initial outlay is going to be 11.7 million, right? So initial outlay, we can definitely say, so the initial outlay is minus 11.7 million, because that's the outlay which have, right? Then let us talk about the future now. Okay. From year 1 till year 6, we are going to have savings in interest. How much are we going to save on the interest, guys?
2%, 10% minus 12 minus 10.
Can I say 300 being the principal value? On that, we are going to save 2%, right? But can we make this as a after-tax item? Because obviously, when we are paying interest and you're going to save on interest, I need to pay tax on interest also, right? Because if your interest is saved, your expense is reduced, so your tax will be increased. So let's make it after tax by multiplying it with 1 minus 0.3, which is the tax rate, right? So what is the cash flow, guys, from year 1 to 6?
4.2.
4?
4.2.
4.2. Yes, 4.2. This is the cash inflow, right? So I'm just writing it as a positive 4.2. Then again, from year 1 to 6, right? From year 1 to 6, there is going to be a differential saving in the tax due to the amortization. Earlier, you had like an unamortized portion of 9. So you were supposed to amortize it over a period of 6 years, right? And you have an unamortized portion of 6 over a period of 6 years. So earlier you were claiming the amortization of 9 over a period of 6 years. So every year you would have claimed an amortization of 1.5, but now you're going to claim an amortization of only 1, right? So since we are going to do this, that, earlier it was 9 by 6, now it's going to be 6 by 6, of course. On that, we are going to save 30%, right? So this is like tax savings, right? We have got the tax saving or reduced. You can say this is reduced tax savings on amortization. Reduced tax savings on amortization of issue expenses. Because earlier you had an outstanding of 9, so 9 would have been divided by 6. So every year you would have claimed an amortization expense of 1.5. Now you are going to claim an amortization expense of only 6. So 6 divided by 6, which is 1. And on that, you are going to pay 30%. Okay. So what is the cash flow, guys?
0.15 million.
0.15, which will be, of course, a negative number because we are going to have tax saving as being reduced. So when you say the tax saving has been reduced, you're obviously going to pay more tax. So now we have all the cash flows written here. Now coming to the present value factor. Right now, you are issuing these bonds at a coupon of 10%, again indicating that ongoing rate of interest is 10%. So what will be the cost of debt, guys? What should be the cost of debt? If the 10% is a coupon rate, the cost of debt, can I say it's going to be 7% after accounting for the tax, right? Cost of debt will be 10% is the ongoing coupon rate, which is the interest that you're offering. And if we make it as a post-tax, this comes out to be 7%. So present value factor is at 7%. Okay. So present value factor, when we say that it is at 7%, then you take the PV, you just calculate the total. Present value factor is at 7%. So let's write down the PV factors over here and then take a look at the total PV, which is NPV, to decide whether a particular bond should be refinanced or not. What is the present value factor for year 1? That's obviously 1. What's the present value factor for year 1 to 6?
4.7665.
4.7665. 767. Let's keep it 3 decimals. So this is also 4.767. Okay. So just multiply it with these PV factors and take the total, guys. Give me the total of all the PVs. Give me the NPV number. So if your NPV is positive, we will definitely go ahead with the bond refunding. Whereas if the NPV is negative, we will avoid that bond refunding activity.
It's 7.59.
7.59. Positive.
Yes.
Yes, sir.
So therefore, bond should be refinanced since the NPV is positive. Okay. Did we get it, guys? Everyone?
Sir, please explain that reduced tax saving on amortization of issue expenses alone.
We had unamortized issue expense of 9.
Yes, sir. I know. So calculation is very clear. How we got 0.15 is clear, but what is the logic behind 9 by 6? That one.
You had an unamortized expense of 9. So what was the purpose of that 9? That 9 was supposed to be written off in your books every year as 1.5, 1.5, 1.5.
Yes, sir.
Right? On that 1.5, you would be saving 30% tax.
Yes, sir.
On that 1.5, you will be saving 30% tax. So 1.5 into 30%. This was your tax saving earlier.
Okay.
And now your tax saving will be 1 into 30%. So can I say the tax saving has got reduced, right, by this figure, 0.15. You're losing on the tax saving, which is a cash outflow sort of thing.
Okay.
Right?
Sir, isn't that the unamortized portion of the old expense? It's like, don't we consider that in the first year when we actually recall it?
That is the initial outlay which you have. I'm talking of the future part. In future, what is the supplemental thing that you are having? So that tax saving which you have right now, that is happening today. But if I look at what is going to happen on a future years, I'm going to save on the interest, and also I'm going to lose on the tax which I would have saved earlier.
Okay, sir. Now I got it, sir. Since we are in the tax, like how the saving on interest from sitting here and seeing in the future, what is the difference? The same way we are looking at the amortization expenses as well.
Yes.
And okay, got it now.
Yes. Because
got
earlier,
it. Thank you, sir.
Earlier our interest was what, 12%? Now it is 10%. So you're saving this 2%. So since you're saving this 2%, you can say that I'm going to save this 2%, and on this 2, I'm also going to pay 30% tax. So we take the net effect. The net effect is 4.2. Same way, only savings on only the tax saving which you're losing, that is counted over here.
Right, sir. Thank you so much.
Okay. So since the NPV is positive, we are definitely going ahead with the bond refinancing. Okay, guys. Yes.
Yes, sir.
Okay, that's question 24.
Sir, this 7% is cost of capital. How we are able to?
Because currently you are issuing the bond at a coupon rate of 10%, right?
Yes, sir.
So it means the current cost of capital is 10%, and therefore you're issuing it at 10%. Right? The ongoing rate of interest is 10%, and therefore you're ready to offer a rate of 10%, right? On the new bonds. So your
Yes,
current
sir.
cost of capital is 10%. You make it after tax figure by removing the tax effect.
Okay.
Right? So we can say, therefore, we said that cost of debt will be 10% into 1 minus tax rate.
Okay, sir.
Okay.
Okay. Whenever the tax rate is given, we have to reduce that debt.
Of course, we have to make it a net of tax figure, right?
Okay. Okay, sir.
Okay. Now, I think we are left with one more question back over here. 17th is pending. I think rest all it is done. Now, similar to bond refunding decision, we have one more question over here. Question 17, guys. Rahul has the surplus cash of 100 lakhs and it wants to distribute 27% of it to the shareholders. So you have like a surplus cash of 100 lakhs, 27% is what you're looking for distribution amongst the shareholders. So what is the amount of distribution that we are looking at? 27 lakhs, guys. Right? Out of this 100 lakh, we are looking to distribute 27 lakhs. The company decides to buy back the shares. Right? The company decides to buy back the shares by distributing this 27%. The finance manager of the company estimates that its share price after repurchase is likely to be 10% above the buyback price if the buyback route is taken. So you can obviously buy back the shares, but you're not going to pay the existing market price to the shareholders. Rather, what am I going to pay? We are going to pay 10% above the buyback price. Right? So we're going to repurchase the share at a price 10% above the buyback price if the buyback route is taken. The number of shares outstanding at present is 10 lakhs and the current EPS is 3. And the current EPS is 3. The number of shares outstanding at present, ongoing rate of number of shares outstanding is 10 lakhs. And the EPS level at current level is 3 rupees. You are required to determine the price at which the shares can be repurchased if the market capitalization of company should be 210 after buyback. So we should determine the price at which the shares can be repurchased if the market capitalization of the company is going to be 210 after the buyback. Then you need to check what is the number of shares that can be repurchased and the impact of share repurchase on EPS, assuming the net income is the same. Okay. Now, we want to buy back the price, at some price, but we have to ensure in such a way that the share price which we observe in the market after buyback, that should be 10% above the buyback price. So there should be a 10% rise in the buyback, 10% rise in the shares after the buyback. So we have to compute what is the buyback price, then the number of shares and the impact of the share repurchase on the EPS, right? So let me just take this question. Rahul Limited, 100 lakhs is what we have right now. So the question asks us, what should be the buyback? I mean, what should be the price of buyback? So let's say existing number of equity shares. We have existing number of equity shares as 10 lakh, right? So we'll say let P be the price at which shares will be bought back. So let us assume that P is the price at which the shares are going to be bought back. So what will be the share price after buyback now? If I say P is the price at which shares are going to be bought back, can you tell me what will be the price after buyback? What will be the share price after buyback? Yeah. What will be the share price after buyback?
So 1 minus P.
Sorry.
1 minus P.
1 minus P. Why?
So P
Why
is the
1
price
minus
of
P?
shares.
P is the price at which you are going to buy back the share. So if let's say P is 100, you want to say that share price after buyback will be 100 1 minus 100. What is the condition set? The finance manager estimates that the share price after repurchase is likely to be 10% above the buyback price. So if it is 10% above the buyback price, it is going to be P
1.1.
1.1 P, right? It will be 110% of the price, 110% of the buyback price. If your buyback price is 100, then it's going to be 110. So share price after buyback is going to be 1.1 P. Okay. What is the amount of cash available for buyback, guys?
27%.
27 lakh, right? So amount available for buyback. Amount available for buyback is 27 lakh, which is nothing but 1 crore into 27%. So can you tell me the number of shares to be bought back? What will be the number of shares that will be bought back? 27 lakh divided by P. Amount available for buyback is 27 lakh. Number of shares to be bought back is 27 lakh divided by P. Number of shares to be bought back is 27 lakh divided by P. Right, guys?
Yes,
Now
sir.
tell me, what will be the number of shares remaining after buyback. Number of shares left after buyback. What will be the number of shares left after buyback?
So 10 lakhs minus 27 lakh divided by P.
10 lakh minus?
27 lakhs divided by P.
Yes. There will be 10 lakh minus 27 lakh divided by P. 10 lakh minus 27 lakh divided by P. That is the number of shares which we are left out after buyback. So number of shares which are left after buyback is 10 lakh minus 27 lakh divided by P. Okay. Now these are the number of shares which were left we had. Now market price we know 1.1 and the number of shares that we have after buyback is something we know, right? Now what will be the market price? I mean, because it says that the market capitalization should be 210 after buyback. So what will be the market capitalization after buyback? Market capitalization after buyback.
That is given 210 lakhs.
Market capitalization after buyback. That is given to be what? 210
10
lakhs.
lakhs.
But how do we arrive at this 210 lakhs? Can I say therefore market price per share after buyback multiplied by number of shares after buyback is 210. So market price per share after buyback will be 1.1p into number of shares that are left after buyback. We have that as 10 lakh minus 27 lakh by P is 210. Okay. So can you solve this equation and give me the value of P? Can you solve this? Everyone?
Yes, sir.
Yeah, so just solve it and give me the value of P, guys.
So P comes to 2.7.
Hmm?
2.7.
How much?
2.7.
0.7, no.
Is it 2.89?
2.89. No. Well, guys, remember this is 210 lakhs. Okay, so this is 210 lakhs. When you say it is going to be like this, yes. Because we want the market cap to be not 210 rupees, but it is 210 lakhs. So I think you might be getting these answers because of these aspects. Try to work around it again.
Sir, it's 21.79.
Yes, perfect. That's 21.79. 21.79 is the price that we are getting after buyback. Got it, everyone?
Yes, sir, got it. 21.79.
21.79. Okay. So now what will be the number of shares that we can really go ahead with the repurchase? Number of shares that can be repurchased. Number of shares that can be repurchased is 27 lakhs divided by 21.79. Okay. What is this number? 27 lakh divided by 21.79.
So 1,23,910.
1,23,910.
910.
910. So this is the number of shares that we can repurchase, right? So what will be the number of shares after buyback? Number of shares remaining after buyback. 1,23,910 is the number of shares that you are buying back. So what is the number of shares left out? 10 lakh minus 1,23,910.
8,76,090.
8,76,090.
90.
The number of shares remaining after buyback is 8,76,090. So number of shares remaining after buyback is 876 and 90, right? 8,76,090. So if you want to know what is the EPS after buyback, we need to look at what is the net income right now. Current EPS is 3, right? So what is the income that we have? net income is 3 into 10 lakh is the number of shares, which is 30 lakhs. Therefore, number of shares after buyback. Number of shares after buyback is going to be 10 lakh minus the, oh sorry, we have already computed this. So net income is going to be 30 lakh. So I can simply say, what is the EPS after buyback? EPS after buyback will be this net income of 30 lakhs divided by number of shares remaining after buyback, which is 876 and 90, which is 3.42. So can I say with an increase in the number of, with a decrease in the number of shares, the buyback after buyback, so the EPS is definitely going to increase to 3.42. Are we clear, guys?
Yes, sir.
Yes, sir.
See? Okay, so we have done with this bond refinancing decision also, wherein we just need to calculate the NPV, and also we have covered EPS aspect also when we're looking at redemption of the share, not redemption, but buyback of the shares. Okay, so we have completed 24, 25, even 26th is done, because that was about the, what we call as, it was the bond immunization part, that is already done. Okay, now after that, we have to go for the remaining questions. So let us look at question 27. But before 27, we need to understand the concept. We need to know what type of instrument are we talking of over here. So we are essentially talking about the treasury bills. Right, so treasury bills. Have you ever heard of this term called as the treasury bills, guys?
Yes, sir. Generally issued by the government.
Government bonds, yes. So what are the treasury bills? The treasury bills are nothing but the debt of the government. So whenever government needs money for short-term purpose, so when the government is in need of money for short-term purpose, the government wants money for a shorter tenure, then government will go to the market and raise money for that shorter tenure. And that entire activity is actually facilitated by RBI. So Reserve Bank of India is, since it is a banker to the government, it is going to issue, Reserve Bank of India is going to issue the treasury bills on behalf of government to the public. Right? So this is, treasury bills are the debt of government which is issued by RBI. Right? So RBI is actually acting as a facilitator for the issue of treasury bills. So debt of the government which is issued by RBI. Okay. Now, so these are essentially the promissory notes. Right? It's like a promissory note which are issued by the government of India. So promissory notes issued, by the government of India. Now, of course, when you say a promissory note, it means it's a promise made by the government to the investor that on maturity we are going to pay this amount. Tenure of investment is 14, 28, 91, 182, or 364 days. So depending on the time period for which the government needs money, depending on the time period for which the government needs money, government will issue that type of treasury bill. So 14 days, 28, 91 or 182 or 364. Most common treasury bill that we find is 91 and 182 days. Okay. And this is actually sold by RBI. These treasury bills are sold by RBI through auction. So there is an auction undertaken by RBI and it is sold through auction, right? And remember, these treasury bills are definitely sold through auction, but an important part for this to understand is these are the sold by RBI through auction, that is agreed. But an important part that we need to look at about this is these sold by RBI through auction, but these are issued at discount. These are issued at discount and redeemed at. These are issued at discount and they are going to be redeemed at par. Right? So they are issued at discount and they are redeemed at par. Because it's the promise made by the government that on redemption we will pay you 100. Right? So on redemption, we are going to pay you 100. So that 100 which you are going to pay is what we are essentially talking as a redemption at par. Okay. Now, let's try to understand it in a different way. So let's say on day 0, the issue has been undertaken. On day 0, the issue has been undertaken at a price of 97. Okay, so the bond has been issued by the government at a price of 97. So we as an investor will be paying 97 today. And the amount that we are going to get on day 91 is 100. So we're going to get an amount of 100 on redemption. So what is the rate of return that we are earning? What is the rate of return that we are earning? It is interest. Can I say simple formula? Interest upon principal into 100 into 365 by 91, guys, because since it's a 91 days, we are earning this interest of 3 rupee on a principal of 100 and we multiply it by 100. Sorry, on a principal of 97, my bad. Because today you are paying 97. So today you are paying since you are paying 97 today, interest is 3. So for interest of 3, the principal is 97 into 100 when you do, that's the percentage. But this percentage return you are earning for how many days, guys? This is what you're earning for 91 days. So if I want to make it an annualized figure, I just need to multiply it by 365 by 91. So, right? So it's going to be interest upon principal into 100 multiplied by 365 by 91. So that is interest upon principal. This is the percentage rate of return that you're earning for 91 days. So for annualized basis, that is for 365 days, what is the rate of return that you're getting? What's the rate of return that we're getting, guys?
12.41%.
12.41%. Okay. So if I want to just generalize this by way of a particular formula, can I do like this? So this 3, I can write it as, we got it as 100 minus 97 upon 97 into 365 by 91. Okay, let's try to generalize this. What was this 100? 100 will remain 100 because it's a face value, because it's always redeemed at 100 itself. Minus 97 is nothing but the issue price. So 100 minus issue price upon issue price into 100 into 365 upon the tenure of the treasury bill. Can we set a formula like this? The rate of return that we can get from a treasury bill or the yield of a treasury bill. Yield of a treasury bill will be calculated like this, right guys?
Yes, sir.
Yeah, so yield will be 100 minus the issue price upon issue price into 100 into 365 by number of days, whatever it is. Correct? Are we able to connect with this formula? Is this formula making sense to you guys?
Yes, sir. Very much.
Yeah. Okay. So now since you understand this formula, give me the answer for this. Give me the answer for this, guys. Hmm.
Is it
How
98.53?
much?
98.53?
98.53, yes. So this formula should be like, 6 is equal to 100 minus the issue price upon the issue price into 100 into 365 by 91. So if you solve this, it should be 98.53. Issue price is 98.53. Right, guys? Are we all getting this 98.53? Were we able to
Yes.
solve it? It'll be like this, 6 into issue price into 91 is equal to 100 minus issue price into 100 into 365. Right, so this is 6 into 91, which is 546. 546 issue price is 10,000 minus, oh, not 10,000, sorry. 91. Let us do one thing. instead of keeping such large numbers, we can essentially have it as 6 is equal to 100 minus issue price upon issue price into, it's going to be 100 into 365 divided by 91, which is 4.01,
Yeah.
right? This is into 4.0109. Okay, so 6 is equal to 100 minus issue price upon issue
This
price
is
into
this is
4.01.
401.1. 401.1. 100 into 365 divided by 91 is
Yeah, so that will be
401.1.
6 issue price will be 401.1. Okay, done. And this is minus 4.011 issue price. So let's bring 6 issue price minus 4.011 issue price is equal to 401.1. Is it this way? So what is 6 minus 4.011? 1.98. No, there is some problem. Some
So
issue
I'm
in the
saying
calculation. Sorry?
100 into 365 upon 91, which is at the end, it comes to 401.1, not 4.01.
No, but 4.01 this. IP we take it on the other side, and 4.011 issue price will be also there, right? Because this entire thing is going to be multiplied. Right? Or is there some problem with this number? Just wait.
When we multiply 100 into 365 upon 91, it comes to 401.1, not 4.011.
401.09 or 4.011. This is the number.
This is incorrect. It will be 401.1.
401.1.
Yes.
Okay, so it is like 100 into 365 divided by
91.
91. One second, there is some problem. It's 401.1. So, into 401.1.
Yes.
So this will be 40110, right? Minus 401.1 issue price. Now let us bring um 401.1 minus 6, which is 395.1 issue price. No, it will get added now. 401.1 plus 401.1 plus 6, which is 407.1. P is 40110. So price will be 401.10 divided by 407.1. So this comes out to be, yes, 98.5.
8.53.
Yes, correct. That's 98.53. That's the issue price which we have, 98.53. Perfect. Okay, let's go for question 28. Wonderland Limited has excess cash of 20 lakhs, which it wants to invest in short-term marketable securities. Expenses related to investment is 50,000. So expenses related to the issue price is 50,000, the securities invested will have an annual yield of 9%. So we want to have an understanding as to what is the period of investment so as to earn a pre-tax income of 5%, and the minimum period for which the company needs to invest to break even its investment expenditures over a period of time. Okay, so on the investments we are earning 9%, and we have got 20 lakhs, and expense which we need to incur as the initial expenditure is 50,000. Okay, so the data that we have to compute two parts to this. Okay, so Wonderland Limited has excess cash of 20 lakhs, which it wants to invest. So cash available is investment amount that we have to make is 20 lakhs. Rate of return on the investment, rate of return on the marketable securities is going to be 9%. So we have the number of rate of return on marketable securities as rate of return on marketable securities is 9%. Initial expense that we need to pay is 50,000. Okay, initial expense that we are going to pay is 50,000. Investment that we have, investment to be made is 20 lakhs. Now, what is the rate of return that we need? Period of investment so as to get a pre-tax income of 5%. The rate of return that we want is 5%. 5% as the rate of return. So, amount of return or required return that we have, we want 5% return on our investment or on our capital. So, required return will be 5% of investment, which is 20 lakhs. That's going to be 1 lakh. So required return is 5% of 20 lakh, which is 1 lakh. So required return, we have 5% of 20 lakh, which is 1 lakh. Then what will be the time period of investment to earn the required return? The question asks us what will be the time period that we need to put our money to get this pre-tax income of 5%, or you can say required, not return, but required income. So we'll say let the time period at the time period of investment let the time period of investment to earn the required return be X days. If we take it as a X days, the rate of the securities is going to have a return of 9%. So securities where you're investing in, it will be giving you an investment or a return of 9%. So what are we going to invest? We are going to invest 20 lakhs, right? So on that 20 lakh investment, we are going to have an income of, on that 20 lakh investment that we are making, we are going to have 9% return for X days, and out of that we are going to pay out 50,000 as the expense, because initial expense that will be expense related to investment will be 50,000. So on 20 lakh, we will be earning 9% for certain number of days. And when I net it off with my initial expense, my net income should be 1 lakh. Right? So on 20 lakh, you're going to earn 9%, but that 9% for X days that you're going to earn, from that you need to actually subtract the initial expense which you have, which is 50,000. So after we account for the initial expense of 50,000, we should be left with 1 lakh. So if this is the situation, can you tell me what is the number of days over here? Yep. What will be the number of days?
304.17.
304.17. Correct. 304.17 days. That's the number of days which we have. 304.17 price. The number of days for which we are going to invest. So if we keep our 20 lakh investment for 304.17, after subtracting for that 50,000, we'll be able to get a return of 1 lakh. Now the second part says minimum period for the company to break even its investment expenditure. So if you want to say the break even point, we will say let the time period of investment to break even the initial expenditure be Y days. So now we can say it is 20 lakh into 9% into Y by 365 minus 50,000. Since it is break even, we want this to be 0. So can you tell me what is this Y number of days? What is this Y number of days, guys?
So 101.39.
101.39. And then 1.39 days. Correct, guys? And 1.39 days. True. Okay, so that is for this question number 28. Right, so we got this question 28. Okay. Now, let's go for question 29. Right, so question 29, we're talking of commercial paper. So, commercial paper, let's understand this concept of commercial paper first, guys. So, do we have an idea what is this commercial paper, guys? Do you have any idea what is this commercial paper? Yeah? Ever heard of this term, commercial paper or CP? In corporate world, we simply acronym it as CP. Well, to understand this commercial paper, it is similar to the Treasury bill. It's just that these bills are not issued by government, but these bills are issued, or these papers are issued by highly rated corporates, right? So commercial papers are unsecured promissory notes. So these are unsecured promissory notes issued by high-rated corporates. High-rated corporates. Right. So commercial papers are the unsecured promissory notes which are issued by the high-rated corporates. Right. So when you look at the established entities, established companies which are having very good ratings, which are having very high ratings. So commercial papers are those papers which are or securities which are issued by the high-rated corporates. Now, the tenure that we have, the term for which this promissory notes are issued, is going to be ranging from 7 days to 1 year. Right? And just like treasury bills, the commercial papers are issued at discount. Right? So they're going to be issued at discount and redeemed at par. Just like treasury bills, these are also issued at discount and are redeemed at par. So commercial papers are going to be issued at a discount and they are going to be redeemed at par. Okay. So commercial papers, as we said, similar to treasury bills, they are issued at discount and redeemed at par. So the yield calculation that we have over here is also similar. The yield calculation that we have, that is also similar to that of the treasury bill. So essentially over here, the face value is not something which is constant, right? The face value is not 100 per se. It could be 1,000, it can be 10,000, it can be 10 lakh also, it can be 1 crore also. So therefore, we are setting a general formula that yield is going to be like face value, whatever is the face value of the commercial paper, minus sale value, the price at which the commercial papers were sold. So difference between them is the interest, and this is divided by sale value into 365 by 91, because if it is issued for, let's say, 91 days, so let me just take it as 365 divided by number of days into 100. So this is how we are going to get the yield over here, guys. Okay. So yield is going to be calculated as face value minus sale value upon sale value into 365 by n into 100. Now, these papers, these commercial papers are issued by high-rated corporates. So which is basically, because since you are going to access an unsecured promissory note, you are going to issue an unsecured promissory note to the public at large. So it obviously the SEBI or RBI is going to ensure that you are having a very high credit rating. Unless you have a very high credit rating, it will not allow you to go ahead with the commercial paper issue, right? So whatever is the highest level of credit rating, maybe by CRISIL or ICRA, you can say, they are going to be catalyst for ensuring that the commercial paper is going to be issued successfully. Then issue is possible only if you are having a very high rating. And just like treasury bill, they are going to be issued at discount and redeemed at par. And therefore, we have the formula for yield as this one. Okay. So now, just try to solve this one, guys. So Z company issued commercial paper worth 10 crores. So what is this 10 crores? This 10 crores is the face value. As per the details, date of issue is 16 January, date of maturity is 17th April, number of days is 91, interest rate is 12.04%. What was the net amount received by the company on the issue of the commercial papers? Okay. So what is the net amount received by the company on the issue of the commercial paper? That is what we want to know. So date of issue is 16 January, date of maturity is 17th April. number of days is 91, interest rate, or this is the yield that we have. So right now, I can apply this formula and say this is 12.04, yield is equal to face value is 10 crores minus sale value is something that we don't know, right? Into 365 by 91 into 100, right? So what is the value of X? Can we solve it, guys? Similar to the previous question. Just try to solve this quickly.
So 9 crores 70 lakhs 85,398.
Okay, let me just solve it. So it's 12.04 is equal to 10 lakh minus X upon X into, so this is going to be again 365 divided by 91 into 100, which is again 401.1. So it's 12.04x is equal to 401. This is into it's 10 crore, right? We have like what? 401, 1, 0, 2, 3, 4, 5, 6, 7. Okay, minus 401.1x. So let's just add both of them, 401.1 plus 12.04. 413.14 is 4011 000 0000. So when we solve this, okay, so answer is 9 crore
70 lakhs
86,000.
85,000
Okay, 85,000
398.
398. Yes. This is the sale value. This is the price at which the commercial paper will be issued, guys. Okay. Got it, guys? Clear?
Yes, sir. Thank you, sir.
Okay. So I think we're just left with one more question in this chapter. I think rest all questions are done. Right? 1, 2, 3, 4th, 5th is done, 6, 7, 8, 9, 10th is done, 11th is done. Yeah. So just one last concept and the question followed by that. So we are looking at some agreement called as a repo agreement or a repurchase agreement. We're looking at something called as a repo or repurchase agreement. A repo or repurchase agreement. So repo or the repurchase agreement. Ever heard of this agreement, guys? Repo or
Yes.
repurchase agreement?
Yes, sir.
Yeah. What is this repurchase agreement?
So this is the rate at which RBI lends to banks.
The rate at which RBI lends money to bank.
Yes.
Right? Okay. But why do we call it as a repurchase agreement? Why repo is said to be a repurchase agreement? What is the reason for that? Well, let's try to understand it with the help of certain numbers. You have RBI and let's say bank X on day 0. Now bank X is in possession of, let's say, 364 days T-bills. Okay, bank is in possession of, bank is having 364 days treasury bills with it, right? If I ask you, the price of these T-bills, right? We can definitely determine the price of these T-bills. Let's say if the yield is 7%. If these treasury bills are having a yield of 7%, can you tell me what is the price of these T-bills? Can you tell me what is the price of these T-bills? If the yield is, I'm just saying that yield is 7%. If the yield is 7%, what will be the price of it? Can we calculate the issue price? Yes. We can calculate it easily, right? 7 is equal to what? 100 minus the issue price upon issue price into 100 into 365 by 364. Right? Correct? So just calculate the price of this, guys, and solve it easily. And just try to get the value of it. Give me the price of this T-bill, guys. Calculate. Calculate this T-bill.
$93.47.
93.4.
Yes. 93.48.
47.
93.47. Right. So this is, so the price is 93.47. Now, in repo transaction, what happens is on day 0, this bank is going to transfer the T-bill to RBI. RBI will give 93.47 rupees to Bank X, right? And it says that you will be charged, let's say, at the rate of 8%, which is the repo rate. You'll be charged how much? 8%, which is the repo rate. That is happening on day 0, right? And let's say this transaction is getting reversed on day 91. So on day 91, you have RBI, you have Bank X. So on day 91, the RBI will return back the T-bill to the Bank X, and Bank X is supposed to be paying to RBI how much? 93.47 plus 93.47 into 8% for 91 days. So what is this number, guys? How much Bank X will have to pay to the RBI? How much money Bank X will have to pay to RBI? It's like 93.47 into 8% into 91 by 365 plus
95.33.
How much?
5.33.
95.33, yes. This is the amount which Bank X is going to pay back to RBI. So the difference between 93.47 and 95.33 is the interest which the bank is bearing, right? So in this transaction, the bank is going to repurchase the treasury bill from RBI. Bank is going to repurchase the treasury bill from RBI on a future date, and therefore this transaction is said to be repurchase. Essentially, Bank X is getting some value against the treasury bill, but it is going to reverse the transaction, that is, get back the treasury bill, repurchase the treasury bill from RBI at a higher value. Okay?
Yes.
Yeah, guys? Yeah? Okay. Now, this was with regards to T-bills. Same way, it can be any other government security also. It can be any other government security also, right? So, whatever is the ongoing price, that is the money which the RBI is going to pay after adjusting for the discounting and all thing, right? So let's understand it in more detail with this question number 30, guys. Bank A enters into a repo for 14 days with Bank B in 10% Government of India bond 2028 at 5.65% for 8 crores. So we have the underlying securities as 10% Government of India bonds. So what do you mean by 10% Government of India bonds? What do you mean by 10% Government of India bonds?
Yield is 10%.
Huh?
Coupon rate is 10%, sir.
Coupon rate is 10%, right? So when we are looking at coupon rate is 10%. So these bonds are going to be coupon paying bonds, not like the T-bills in which there is a discount and they will be redeemed at par. So Bank A is entering into repo for 14 days with Bank B in 10% Government of India bond for 8 crores. So this 8 crore is the nominal value. This is not the amount of money that you're going to receive. This is the nominal value. Clean price, the price that does not have an accrued interest, is 99.42 and initial margin is going to be 2%. Right? Assuming that clean price, the price that does not include accrued interest, is 99.42. So I hope you have learned the topic of investment accounting in CA Inter, right?
Yes, sir.
You remember investment accounting in CA Inter? In that, there was the concept of accrued interest, X interest and cum interest price.
Yes, sir.
Right?
Yes, sir.
So this 99.42, is it X interest price or is it cum interest price?
X interest. X interest.
X interest price. So 99.42 is X interest price, right? So we have the 99.42 as a X interest price. Initial margin, they're saying it, we have to keep some sort of margin as 2%. And days of accrued interest, it means on this 99.42, we have an accrued interest of 262 days. We have to determine the dirty price and also the repayment on maturity. So dirty price is nothing but the cum interest price. So dirty price is nothing but the cum interest price. And this 99.42 is a clean price, which is X interest price. So we have the clean price given to us because I need the total price before we do any sort of transaction. So first we talk of clean price. What's the clean price that we have? 99.42. On that, we are going to have accrued interest. Accrued interest is 10% Government of India bonds, right? So it is 10% of 100, right? On that, how many days of accrued interest is there? 262.
262.
Right? 262 days. And we have to consider 360 days in a year. So 262 divided by 360. So what is the amount of accrued interest? That's 10 into 262 by 360. How much is it?
7.277.
7.278,
277.
right? So what will be the total price, which we also call it as dirty price, which we also call it as cum interest price. It is 99.42 plus 7.28. Yeah, what's the total price? 99.42 plus 7.28.
$106.7.
106.
106.7. That's the total price which we have. Then, what is the nominal value of the repo? Nominal value of repo was 8 crores, right?
8 crores. Yes.
8 crores. So what will be the total value of repo? Total value of repo is 8 crores divided by 100. That's a face value. And the total price is 106.7. So total value of repo transaction is 8 crore. How much, guys? I think it should be 8 crore. What? 50 lakhs somewhat. 8 crore divided by 100 into 106.7, because 8 crore was the face value of the repo transaction. But since the total price of the securities is 106.7, what will be the total value of the repo? Eight crore into
853. 6.
Sorry, 8
crore 53 lakh 60,000.
60,000.
Yes.
8 crore 53 lakh 60,000. That is the what we say as a. Are you sure it is 60,000?
Yes, sir.
Exact.
Yes.
Some number. Okay. This 8 crore Yeah, fine. The 8 crore 53 lakh 60,000. That's the value of the repo. Now, when we are undertaking this repo transaction, Bank X is not going to get the full value of this government security because there is a 2% margin given to us, right? So what will be the proceeds of repo at time equal to 0? Can I say it will be 8 crore 53 lakh 60,000 into 1 minus 0.02 or 1 minus 2%. So this into 98%, which is 8 crore 36 lakh 52,800, right? So proceeds of repo at time t equal to 0. So at the initial time, we are getting this 8 crore 36 lakh 52,800 as the proceeds, right? This is the principal that we have. Now, how much interest are we supposed to be paying on this? What is the interest payable? Interest payable under repo. Can I say 8 crore 36 lakh 52,800 into interest payable under repo 8 crore 36 lakh 52,800 into
5.36.
5 point. What's the rate of interest charged?
5.65.
5.65% into how many, for how many days is the repo undertaken?
262.
14 days.
No. It's 262 is accrued interest. Repo is for 14 days only. So interest will be charged for 14 days into 14 by 360. Yeah. What's the amount of interest payable under repo?
One lakh 83,803.79.
It's 1,83,000.
803.79.
850.
803. 803.
803. Okay. 803.09.
79.
0.79. Okay. Right. So what is the repayment happening at time t equal to 0? Repayment at time t equal to 14. Which is 8 crore 36 lakh 52,800 plus 1 crore 83 lakh 803.79. Add them.
8 crore 38 lakh 36. No.
8 crore 38 lakh.
Yeah, 36,603.79.
79. Yes. This is the repayment that is happening at time t equal to 14. Got it, guys?
Yes, sir.
Okay. Mega is asking difference between commercial bill and commercial paper. Commercial paper is something that we have similarity with the T-bills, right? Whereas, the commercial, commercial papers are issued by highly rated corporates for raising funds similar to that of, government entities, right? So,
Similar to treasury bill.
sorry.
Similar to treasury bills.
Yeah, similar to treasury bill. Instead of government, it's issued by the government. It is issued by the corporate. Whereas commercial bill is your bills receivable and bills payable thing, wherein you have a debtor and a creditor. The bill is drawn, right? So that is a commercial paper. Commercial bill. So bills receivable, bills of exchange is commercial bill, right? Whereas commercial paper is issued by the highly rated corporate to the public. Commercial bill is generally between the buyer and seller, basically between debtor and a creditor. Okay, I think you might have learned something about the bills of exchange and foundation level.
Yes, sir.
Yeah, so that is your commercial bill. Okay. So with that, we are through with this topic of security valuation. We have covered all the concepts and the questions that we have in it. Right, guys? I hope we are in a good position to understand the concept and also to solve the questions.
So
Right?
on the repo, we have the reverse repo also, right, sir?
Yeah. So
Is
reverse
that relevant? Yeah.
reverse repo is the opposite of the repo transaction.
Lending fund by buying security
Yeah.
and agree to resell.
Resell, yes. Agreeing to resell. Right. So you basically give money to RBI. RBI will give you government securities. Later on, you have to give back the government securities to RBI. RBI will pay you back money with interest. Of course, the reverse repo rate is lower than the repo rate. Correct?
Yes, sir. Is there any sum for that?
No, that is not
Question.
much relevant in India, because why would any bank put money with RBI to such a large extent? Rather, they would invest it to the public at large.
Okay.
Right? So it's just the opposite transaction. Nothing difficult. Nothing different in it. Okay. So
Right, sir.
security valuation, we are winding up today. And let's just take a break right now, guys. And after break, we are going to start with another topic called as portfolio management. Okay, so we're going to do with the basics of portfolio management, certain basic formula, some basic, not questions. We won't be starting with the questions, but we'll be starting with the introduction part and also certain basic formula that we need. Okay, let's take a break, guys. Break of around 15 minutes, and we come back and get started with the next topic, which is your portfolio management. Okay.
Yes, sir.
Yes, sir.
Okay. So let's get started with another interesting topic filled with quantitative techniques, portfolio management. Okay, portfolio management. What are we really going to discuss in this topic, in this subject, or this portfolio management? As you might be learning now as just one of the chapters of your AFM paper, but then you need to understand that this particular topic is a subject which is learned in its own. Okay, so it's a subject which is studied as a separate area when you go into any post-graduation part. Okay, so it's going to be very much quantitative part, right? And a lot of your statistical techniques will be, essentially learned or will be essentially tested in this particular topic. So there's a separate stream of study as a subject. It is learned in the portfolio management, right? So in finance, it is a separate subject which is learned in post graduation, as I said. So what are we really going to learn in this portfolio management? Yes, let's try to build this particular topic in front of you, and then we'll understand what are we going to study in this. The first thing that we are talking is, how do we calculate or determine the value of an asset? How do we determine the value of an asset? Yeah, tell me, guys. How do you determine the value of the asset?
Present value of future cash flows,
Perfect.
which comes
Exactly.
from that asset.
Perfect. It is present value of future cash flows. So value of asset is essentially present value of the future cash flows. So value of asset is what we call as present value of future cash flows. Now the question is, when we calculate the present value, and how do we look at the future cash flows? Now, future cash flows can be forecasted. These cash flows can be forecasted from macroeconomic and microeconomic data, right? So you have the data that what is the likely level of GDP growth India is going to have, what is the growth level that we can expect in a particular industry, what is the level of growth that we may expect in a particular industry. So based on that, you will be obviously able to calculate the cash flows as to what will be the level of sales. Then in that you're going to get influenced by the inflation and other aspects. So a lot of things are going to be taken care in that situation. So the value of asset, we say generally it is what? Present value of future cash flows, which is the cash flows can be forecasted from macroeconomic and the microeconomic data. Okay. So you can have scenarios for future, what could be the likely level of sales, the likely level of expenditure level, the inflation level, and all on that basis, you can simply calculate the cash flows. Now we have the other thing to calculate, which is present value. Now, to calculate present value, to calculate this present value, we need a rate of return or a rate of discounting, right? So present value, to calculate the present value, we need a rate of return or rate of discounting, right? So present value of future cash flows. We want to determine the present value of future cash flow. So how are we going to determine the required rate of return on an asset? Because present value, when we calculate, we discount cash flows at required rate of return. So discounted cash flows will be calculated using the required rate of return. Now, the second question we look at is, how do you determine the required rate of return? How to determine required rate of return on an asset? Yeah. How do you know that you want 12% on a particular share, or 14% on another share, or 6% on a debenture? Yeah, guys. So how do we determine that required rate of return? How do we determine the required rate of return, guys?
That would be the expected return.
No,
investor expects.
we're not talking of expected return. We're talking of required return. Expected return is a return which the security or the asset is going to give you. We are talking of the required return.
The similar kind of asset that we have.
Similar kind of asset that we have. What if similar kind of asset is not there?
Bank rate.
Why will you get a bank rate? Will you ask for a bank FD rate of 6% on the equity shares? Of course not. So how is this required return calculated, or what is going to determine the required return? So we can say required return depends on the risk of the asset. Right? The required return actually depends on the risk of the asset, which simply means high risk assets will be required to give higher rate of return. It will be required to give higher rate of return. Right? So high risk assets will be required to give a higher rate of return. Okay. So high risk assets will be required to give us a higher rate of return. Okay. So we can also say that high risk asset cash flows will be discounted at higher rate of return. Okay. Right. So higher rate of return will be used to discount it. Now the immediate next question that follows this: how to measure risk? How to measure risk in an asset? Right? That is what we are going to answer in this particular chapter, guys. Also, it's not just that we are going to see how to measure risk on an asset. We'd also like to know that for a given level of risk, what should be the required, for a given level of risk, what should be the required rate of return? Right? For a given level of risk, what should be the required rate of return? So how are we going to measure the risk? That is what we are going to first see. And then the second thing is, for a given level of risk, what should be the required rate of return? Right? So suppose you measure the risk. Now for a given level of risk, for the calculated level of risk, what is the rate of return that you need? That is something which we need to obviously discuss over here, right? That's the thing that we're going to cover up. And also an important aspect, as the name says, it's portfolio management. We're also going to see how to create portfolio of securities. How to create portfolio of securities, right? Or we just don't want to create a portfolio randomly, but we want to create a portfolio that makes sense. Now, when I say it makes sense, we're talking of optimum portfolio. Right, so we're going to see how to create a portfolio of security, which is the optimum portfolio, guys. So how do we create the optimum portfolio of securities? Now, what do we mean by optimum portfolio? Optimum portfolio is something which results in what? Maximize
Return,
Yeah.
less risk.
max return at given risk, right?
Yes, sir.
Or minimize risk for
Maximize return.
required return. You can't do both things together. You can't be looking at, I will maximize return and minimize risk. No, that's not possible. You can't pull it both ways. Either you can say, let us keep the risk constant, and for that level of risk, what should be the portfolio which will give me the maximum return? Or you will talk of like, okay, I want this rate of return, and for this rate of return, what is the minimum risk possible?
Okay, sir.
Okay, so
Means we have to do constant one thing.
you'll have to keep one of the things constant. Then only you can think of portfolio creation. Otherwise, it actually doesn't make sense, right? Because how is
Yes.
it possible that you want high return and also low return? High return and also low risk. That is, defeating the very basic fundamental of finance, that you want high return but at lowest risk. Then anyone would like to say, let us create a portfolio which will give me the return of, let's say, Bitcoin for a risk-free security. At zero risk, I want, returns of Bitcoin. That is not possible, right? So you need to keep one of the things constant, that, okay, I can have a risk of this particular level X. And for this X level of risk, what is the maximum return possible? Second thing is, I can have a minimum level of risk, right? And, for let's say I want a return of, let's say 20%. So for 20% return, what is the minimum possible risk? Okay. So we are in the process to create this portfolio of security, which are the optimum portfolios. So what is the roadmap that we have in this particular chapter? So what are we going to really learn? So roadmap that we have for this particular chapter is, we will first essentially learn something called as measuring the risk and return of securities. So measuring risk and return of single security, I'll say. Second thing is, again, we are going to measure risk and return, but of portfolio of security. Portfolio of securities, right? And this is what we call as the Markowitz model. Okay. Then the third part is, we need to also look at understanding the utility and assignment of portfolio to investors' utility, right? So we're going to talk of something called as utility measurement. Utility measurement and assignment of portfolio to investors utility, right? Then we are going to have something called as capital allocation line, right? So this is something called as an extension of this thing. So each of these are the portfolio concepts, and these all concepts or these all theories are Nobel Prize winning theories. So capital allocation line followed by capital market line, then followed by securities market line, right? Followed by securities market line, which is also we fondly call as CAPM, capital asset pricing model. Then Sharpe's single index model, right? So Sharpe single index model. Then we have like arbitrage pricing theory. These all are the Nobel Prize theory, theories that we are going to look at. So arbitrage pricing theory. Then portfolio. Also, the last part is portfolio performance measures. So we want to know how well our portfolio has performed. So how are we going to measure that? So we have portfolio performance measures. Okay, so arbitrage pricing theory followed by portfolio performance measures. Okay, so this is the roadmap that we have to discuss, right? Now, how do we go about measuring the risk and return of a single security? Let's first understand that aspect, okay? Now, when we want to calculate return of security, return of security is going to be calculated as, P1 minus P0, right, plus D1 upon P0. You multiply it by 100. So let's say we have certain numbers like this: year and price and the dividend that we have. Okay, so in year 2016, let's say you had a price of 100. Then in 2017, the price turned out to be 110. Then 2018, the price turned out to be 115. In 2019, the price turned out to be 125. And then in 2020, the price turned out to be, let's say, 140. The dividend that you got, obviously 2016 dividend is of no use to us, but for 2017 dividend that we have, we got a 2017 dividend of 5 rupees. Over here, you got it as 7. You got it as 8. And then here you have a dividend of 6 rupees. So how do we get the amount of return that we are earning? So what's the return that we have earned from this security in the year 2017? Return that we have in 2017?
15.
It's going to be 110 minus 100, which is a previous year price, plus you
5 divided by 100.
110. So what's the return? 110 minus 100 plus 5, the whole divide by 100.
Divide by 100, Sarangan.
Sorry, divide by 100, yeah.
15%.
15%, okay. What about the year 2018? So we say it's 115 minus 110 plus 7 divided by 100. Yeah. So what's the return over here for 2018?
12%.
How much?
17%.
12%.
1%.
12. Sir.
Exact 12?
Yes.
Okay. The next one, 125 minus 115 plus 8. The whole divided by, sorry, it's not 100. It's going to be 110, my bad. Because the
Yes.
previous price was 110, right? Yeah, I think this number is going to change. How much is it?
%10.91%.
7 divided by 110. So that's 10.91%, right?
Yes,
And
sir.
then this is going to be divided by 115. So what is the percentage return? Yeah. 16.8%.
15.6.
16.8 or something different?
15.6, sir.
Sorry?
15.6.
15.6%. Just confirm, guys.
Yes, 15.65%.
15.65. Okay, we'll just keep it as. So next is 140 minus 125 plus 6. The whole divided by 125.
16.8, sir.
16.8.
8.
Exact 8. Or do we have something
Yeah.
else?
Exact it.
16.8%. Okay, so these are the expected returns that we have. These are the returns that we have for the share from the previous year. Now, if I ask you, what is your expected return from this? How will you calculate the expected return from this? How do we calculate the expected return from this, guys?
Summation divided by number of years.
Sorry?
Summation.
We will do the average, sir.
Average, right? So it's going to be summation of all the returns divided by number of years, right? So just give me the average number.
$58.36, sir.
Sorry?
58.36.
Total.
Yes, sir.
58.36.
36.
So what is the average return that we expect? 58.36% divided by 5. Sorry, not 5. Divided by 4.
4.
4.
14.59.
14.59. 14.59%.
Yes, sir.
Right. So that is expected return is 14.59%. Right. So expected return that we have is 14.59%. So 58.36 is the total thing and 14.59 is the expected return. Right. So expected return is 14.59%. Now, if I ask you whether this security is risk-free, yeah, whether the security is whether the security is risk-free, yes or no?
There is risk.
Sorry? Is it risk-free or is there risk in this?
Risk, sir.
There
There
is
is risk.
there is risk.
Yes, sir.
Why do you say that there is a risk?
Sir, dividend may change, its earning may change.
Dividends may change, earnings may change. No, just based on this previous numbers. Just based on these previous numbers, can I say the numbers are quite, the returns are not constant. There is a lot of fluctuation happening in the, this particular thing, right?
Yes, sir.
So there is a lot of calculation. I mean, the numbers are not constant, and whenever there is, we find that the numbers are, not constant, but there's a lot of change or volatility that we have. Right? There's a lot of change or volatility that we have in the return. Therefore, we say there is a risk in this. Now, if you just say, what about a risk-free security? What about a risk-free security? Will you expect the risk-free security to be having the returns in this pattern?
No, sir.
No, sir. It will be constant.
Security will have a consistent return.
And
Constant.
every year you'll have like 7%, 7%, 7% return available for you, right? So when we have every year the same amount of return for us, of course we can say that it's a risk-free. But now since there is a deviation over here, we say that there is a risk in this particular security. So how do we measure that dispersion or deviation? Risk of the security. In our simple model over here, how do we measure the risk of security? It is nothing but standard deviation of returns of security. It is simply going to be the standard deviation of returns of security. Right? So risk of security is simply going to be standard deviation of returns of security. Right? So standard deviation of returns of security is what we're going to call as a risk of security. We're going to measure the dispersion in this return. So how do we measure this dispersion? What's the formula for standard deviation, by the way, guys?
Expected return minus average return.
It is going to be security return minus the expected return. We take a square of it, divide it by n, and then take a square root of it. Right? So summation of return minus expected return, the whole square divided by n. Correct? The risk of security return minus expected return. So we look at the difference. Then we take a square to remove the negative effect. And this is what standard deviation we already learned in the chapter of, capital budgeting, advanced capital budgeting. So risk of security is this. So now for that, I'll have to first add a column as return minus the average. Then we take a square of it, right? And take a total. And then we just have to substitute over here. So can we do this calculation, guys, quickly? Yes or no? Can we do it?
Yes, sir.
15 minus 14.59 will come over here. 10.91 minus 14.59 will come over there. And then just take a square of it. Take a total of it.
It comes to 2.21 for me.
What's the total?
The total is for me it is 19.6141. 6141. 19.6141.
15 minus 14.59. This is 0.41. 10.91 minus 14.59 is minus 3.68. 15.65 minus 14.59. 1.06. 16.8 minus 14.59, which is 2.21. 0.41 square, it is 0.1681. 0.68 square, it is 13.524. Then 1.06 square, it will be 1.1236. And 2.21 square is 4.8841. Okay, so what's the total of all of this? 0.1681 plus 13.5424 plus 1.1236 plus 4.8841, which is 19.7182. So the risk of the security standard deviation is 19.7182 divided by 4. 19.7182 divided by 4 is 4.92, and then we take a square root. So it is 2.22. So 2.22% is the standard deviation, which is, we can say that in most of the cases we'll find that the return is likely to fluctuate 2.22% above or below the expected return, right? So this is a measure of risk, right? So we have seen how to calculate the risk and return of a single security based on past data. Okay. We'll discuss more about this based on probabilistic model and everything in the upcoming session. Now, let us just go ahead with some MCQ questions. Okay. Let me just share with you the MCQ question thing.
Sir, totally 5 years. Why we are considering 4 years, sir?
Because we have returns number for only 4 years, right? Returns are 4 in count. Share prices you have for 5 years. But the return data is for only 4 years, right?
Okay. Based on the return, we are...
because you are calculating the standard deviation of return.
Okay.
Right? Okay. Fine. So let's go ahead with these quick questions, guys. The first one. A 91-day T-bill with a face value of 1 lakh is issued at, let's say, 97,800. What is the annualized yield? What will be the annualized yield, guys? Calculate it.
8.8.
8.84. 8.84. Well, this will be calculated as 1 lakh minus 97,800 divided by 97,800, right, into 91, so into 365 by 91. Now 8.84, how is it? It's 9.02.
Yes, sir, it's coming 9.02. But the answer B, we can write B.
Approximate, yeah. Closed answer is 9.02. It's not 8.84. How did you get 8.84? Did you divide it by 1 lakh?
With the, yes, sir.
Divided by the principal, which is 97,800. Okay. A company issues 180-day commercial paper with a face value of 10 lakh at a discount rate of 9% per annum. What will be the issue price? Just see which is the closest issue price possible over here. Think. At a discount rate of 9% per annum, guys. Remember, we're talking of the discount rate of 9% per annum. It's not a yield of 9%, guys. Just take a note of it. So we need to get the amount of discount. So when you're talking of discounting, it is going to be based on the face value. So discount is going to be 10 lakh into 9% into 180 divided by 365. The discount amount is this. What will be the issue price then? 10 lakh minus this. So it is 9 lakh 55,000. 1 second. This is 10 lakh into 9% into 180 by 365. So that's 44,383. So 9 lakh 55,616. Yes, so this is the correct option. Sorry. The closest one is
600. D, answer D.
56,000 it is, right?
Yeah,
They're getting
9 lakh 55,000.
Yeah. But this is 56,000.
Yeah,
So option B is
55,000.
B was
Answer B.
342. It is closest, so it's going to be this one.
Yeah, right, sir. I didn't look at the 56. I thought it's 50. My mistake, my bad.
Yeah. Okay. Okay, so a bond with a face value of 1,000 carries 10% coupon rate, payable annually, has 5 years to maturity, required yield is 12%. What is its intrinsic value? Very simple question, guys. You just have to get the value of the bond by taking the present value. So in this, the rate of discounting is going to be 12%. For how many years are we going to have the coupon? 5 years, and the coupon amount is
5 years.
100.
100.
And it's going to mature at 1,000.
927.9.
5 years.
So that's 927.9. True. So you take the present value of all the coupons together, discount rate 12%, that comes out to be 927.2. Okay.
It's a TC.
Okay, this one. A company has paid a dividend of 5. Dividends are expected to grow at 6% per annum. Cost of equity is 12%. What is the current value of the share? Gordon model, D1 upon K minus G.
Yes, sir.
So it's going to be 5 multiplied by 1.06, which is D1. And we divide it by 0.12 minus 0.06. 88.33. Okay. Then the next one. A company is expected to pay dividend of rupees 8 next year. Growth for 3 years will be 15%, after which it stabilizes at 6% perpetually. Cost of equity is 12%. What is the intrinsic value? Do we remember?
Two-stage model.
Two-stage model, yes. Get the answer, two-stage model. We need to have like year and the dividend, and then we just need to take the PV.
Yeah, we need to find the fourth year dividend.
Yes.
To compute that terminal value.
4, 3. The cash flows are going to be like what? Dividend next year is 8. After that, the dividend is going to grow at 15%. Third year also, the dividend is going to grow at 15%. And to that, we are going to add the present value of the price. So what is the value in year 3? Value in year 3 will be price in year 4 divided by KE minus G. So price in year 4. Price in year 4 will be
176.33.
10.58 into 1.06 divided by 0.15 minus 0.06. So 124.61.
124.
Correct? That's 124.61. So I'll just add it here. Then we take the PV at 12%.
So K is equal to 12%.
Yes. Sorry. What did you just say? This is, oh yeah. This will be 12%, yes. So present value will be this divided by 1.12 is to number of years. So you can just take a PV of it. And the total that we have is what? Is it one?
What was the answer for the third one?
Third one?
The third question. What was the answer for third question?
927.9.
Okay.
Okay. So the intrinsic value. So we get the value as what? We are discounting it at, what is the price that we have? Is it 10.58? 10.58 into 1.06. Yeah, so that's 155. This option is incorrect, sir. 155.05. Okay. So option B. So I think there is some issue with the options. Anyways, are we getting this 155.05?
Yes, sir. If the option is incorrect, we are lucky, sir, actually. Anyway, mark will be provided.
No, don't worry. That we won't let you happen.
In some of the cases, I have seen there.
We will definitely not allow that thing to happen.
No, the Jagbandhu sir, Samanathan is very correct. Is very correct because once if there are any, if there is any
issue with the options,
type of confusion is there, so everyone got the mark. Every option is correct.
I know, but sir, we obviously tried that.
We should try. Okay,
Yes, sir, but we will try approximately which answer will fit it.
Yeah. But that's why that's why I am saying in case if an examination, if any out of 4 option, once you have tried it, then again you have tried it and you find that none of the correct option is matching. So please don't get nervous. Okay. If there is none of the option is matching, don't worry. We will take care of the same.
Super, sir. Thank you, sir.
Okay, sir.
So Jagbandhu sir, it is over now, or anything is left? I think on mute, Jagbandhu sir, you are on mute, I think.
Yeah, we are done. We are done with the MCQs. Security valuation is done, and portfolio also we have just got introduced.
Okay. So student, with this we have come to the end of chapter number 5, that is 1/3 of your syllabus. And most good part of our classes is that students are interacting. Now this is one of the very important aspects. I just share with you one instance. Now recently one of our known has sent me one mock test series 2 for the evaluation purpose. So what I have done, I have got it evaluated, and there is one question, I think it was in merger acquisition question, 5th A question. There was one error of misprinting in question paper because one extra zero has been printed. So what happened? The student has done the correct answer, but I marked it wrong because I was just taking care. I was just comparing with the solution, and so then he contacted. He called me over the telephone. Sir, why you had crossed my answer? I said, you have considered one more zero. He said, no, sir, it is mistake in your suggested. This is your mock test question paper. So then I again looked at it. Then I found it. Then I realized that there is a mistake, and quickly I replaced the wrong question with the corrected one. So student, now that's the reason we always say you should interact. Now in this last MCQ when there was an error, so and even one student was saying, sir, the discounting rate is 12%. So you are the only guiding factor for us. So keep on interacting with us. Even I always invite students that if in any study material, if you find any inconsistency or anything, please feel free to share with me over the telephone. Okay, to write any long email, because when you write a mail, what you want to convey may not be conveyed as per your own perception, and I may not conceive the message on the same line. So it is always better if you can contact me over the telephone. So my telephone number is there and email ID is there. If you have any query, please feel free to ask us. Now in the next class, we shall continue the topic of portfolio management, and assignment will be get uploaded 2 or 3 days before the class. It will be get uploaded. So that in the next class, Jagbandhu sir, in the next class, assignment will be started, na?
Yeah, we'll start with assignments.
Yes, sir. Okay, student. Thank you. Revise whatever we haven't covered in class till this class today, and if you have a query, you can ask even in the next class as well. So, student, thank you very much, and for the patient listening, and have a nice day. And thank you, Jagbandhu sir, for sparing your precious time and letting down a student on the topic of security valuation as well as portfolio management. Thank you very much.
Thank you, sir. You have really explained very well in the concepts. Thank you.
Thank you.
Thank you, sir.
Thank you, sir.